but you're going nowhere. Don't blame me for what you've done, because I know that you were having fun.
Welcome to the Clarified Realty Podcast, exposing the real estate secrets your agent doesn't want you to know. Here's your host, Tom Clary.
Don't you just walk away. That's when I'll say.
Hi, everybody. Welcome to the Clarified Realty Podcast. My name is Tom Clary, and I'm your host. I'm a real estate agent here in the beautiful state of California, Los Angeles to be exact. Our good friend and constant co-host, Ron Bruno, is not with us today. He has fallen ill and is recuperating at home, so it's just me today. But I have a very interesting guest on today's podcast. It's Richard Hershey of WeReduceTaxes.com. He helps work with investors to save money by deferring their capital gains taxes with alternates to the 1031 exchanges. So what are 1031 exchanges? Well, we'll get to that. So hold on a second. We'll just don't worry about it. But first off, I want to thank Richard for coming. Richard, thank you very much for being here.
Thanks so much for having me.
So we ask this for everybody when they come in here for the very first time. So basically, where were you before this and how the hell did you get here?
That's a question I ask myself almost every morning when I get up. Well, Tom, thanks for having me again, and Ron as well. The path I've traveled has been one of working with the investment markets, the real estate markets, and more importantly, the tax code, and trying to find ways that we can take advantage of legal remedies to leverage tax savings.
Yeah.
I'm blessed with not having to be an attorney or an accountant because I am blessed to have raised an attorney, but
I'm married to one, so
But if you do your research and you do your due diligence, you're surprised at what you can find out there.
Right.
I started my career early in the healthcare industry and was a corporate executive for a long time and grew up in the merger and acquisition phase. And so I've always had an interest in syndicated deals, syndication, that type of thing.
Right.
And that led me to the 1031 space, which I know we're going to talk about here in a moment.
Right.
But what I realized is that the reason why some of the very large investors and very large companies are successful is that they take advantage of the tax code. For you and I as just individuals, the tax code could be very onerous.
Yeah.
There's thousands.
Especially now.
Exactly. There's
even more so in the last
even more
month or
so with the confusion of the recent changes.
Right.
But in general, there's thousands and thousands of codes, and then you multiply that by the state, and then by municipalities, and it's very easy to get lost in the weeds.
Yeah.
I like to joke and say, look, the tax code has thousands of pages and thousands of codes.
Yeah.
I'm just fortunate enough to know 5 or 6 really well.
Yeah, right. The ones that really count.
That's exactly right.
Right.
So I've been blessed with an opportunity to uncover something that has actually been around longer than the 1031 exchange. And the way that we've been able to utilize it is very creative. But I want to stress it's 2 parts. One part is a tax code that actually is currently well over 80 years old and predates the 1031 exchange by almost 25 years.
Wow, that's interesting.
The other part of it
I didn't know that.
Yeah.
And we'll get to what he's talking about. Is basically what you guys emphasize, which is a trust. But we'll get to that. But I didn't know that it predates the 1031.
It does. And the second component of it is a special vehicle, which we'll talk about in a moment, and that actually dates back hundreds of years.
Wow, really?
So we have a technique. Sometimes, the old ways are still good ways,
Right.
and many times it's the better way.
Right.
But maybe we could talk about the 1031 exchange.
Well, yeah. Let's get to that because and it's interesting, and I'm so. What was fascinating was when we first booked Richard here with to get him in here to talk to us. I was excited for numerous reasons. Number one, the first reason, there's 1031 exchanges are a completely kind of a nebulous, misunderstood thing within agents and stuff, especially like the younger agents and stuff like that. It's a weird idea of what a 1031 is. So why don't you go ahead and explain what is a 1031? How does that have anything to do with real estate?
Thank you. Well, 1031, let's clarify what it is. It's actually technically called a Section 1031 exchange, and it's actually a code within the IRS tax structure. Just as a side note, it's important to know that tax codes are never named. They're always numbered.
Okay.
So in this particular instance, this code is section 1031. The essence of a 1031 exchange is you can take property A. So maybe you've purchased a 4-unit apartment building maybe 10 years ago, and you're looking to perhaps sell that. One of the issues that most sellers review when they consider selling an asset is the impact of taxes.
Right.
When you sell an asset in the investment real estate space, you're looking at a couple of different taxes. The big one, obviously, are capital gains.
Right.
We're in California, and we pay a great privilege to be here in California.
Right.
So we have amongst the highest tax structure in the country.
Yeah.
So currently, capital gain rates are between 15 and 20% from the federal government.
Right.
They are, the state of California has one in addition to the federal rate, which is anywhere from 8.3 to as much as 13.3.
Right.
And now there's a recent addition over the past few years. I know this isn't a political show, but depending upon
I don't know. We've had a couple of episodes that got a little bit, but go ahead.
Well, some people refer to it as the Obama tax, and technically it's called the Medicare tax.
Right.
On real estate transactions in excess of $250,000, there's an additional 3.8% tax. So an example would be if you have $1 million gain in the state of California, you potentially could be as liable for as much as 37.1%. Right.
So to just kind of simplify things. So let's say I bought some sort of investment property for $1 million. It's now gone up to $2 million, right, over the course of appreciation and all that. And I want to sell it. I'm going to have to pay taxes on that $1 million that I actually just gained, basically, right?
That's correct.
And to the tune of 30, what did you say, 37, 38%?
Yeah, so percentages are easy to be deceiving. That's why the government likes to use them. I prefer to use dollars because that's what we pay in, right? So for an example, on $1 million gain, you'd be subject to a 20% capital gain level. On $1 million, that's $200,000. Wow. Now that's just to the federal government.
Right.
The state of California imposes a 13.3% capital gain tax. That's equal to $133,000.
Right.
And then, as I mentioned on the Medicare tax, it's an additional 3.8. So 37.1% of $1 million, believe it or not, is $371,000.
Wow. Now, if there are deductions though, correct, for if it's a personal residence, right? So it's like one is $250,000 and one's for like a single person and $500,000, I think, for married. Is that correct?
Yeah, Tom, that's correct. Let me pause and review it.
Okay.
Just because, unfortunately, I wish the 37.1% was just the stop of the taxes on the.
Oh, there's more. But wait, there's more.
There's more. And unfortunately, it costs more, right?
All right.
So remember, one of the benefits of owning investment real estate is the ability to depreciate the asset.
Yeah. Right. Yeah.
Well, that's great while you own it and you're earning income.
Right.
Unfortunately, when you sell it, that level of depreciation comes back into the transaction and is now taxed.
Yes.
So in the example we were using previously, where you had $1 million gain,
right,
you would also have to recapture. So the term they use is depreciation recapture. The tax on that is an additional 25%.
Whoa, I didn't know that. Wow.
Yeah, so if we review it, it's 20% to the federal government, 13.3 to the state of California, 3.8 to Medicare, and to the degree that you took depreciation of the asset,
right,
it's an additional 25% of the amount that you depreciate.
Right.
So to put a number on it, if you took $100,000 worth of depreciation during the time you owned the property, you'd owe an additional $25,000 in taxes.
Wow.
Now, to shift gears for just a moment, you mentioned the primary residential exemption.
Right. Which this doesn't apply to commercial. So this is all just about people who their houses gained money over the years and all that, and they want to sell them.
Right.
Yeah.
For some of your older listeners like me, they may remember that you may be, in the past, you were able to exchange your home to another home of equal or greater value on a tax-free basis. Many of your listeners may have parents or grandparents who have that understanding. That's been gone for a very long time. What has replaced it is as a primary homeowner, you have what's called a Section 121 exemption. If you're single and you sell your home, the first $250,000 of capital gain is tax-free. If you're married, that increases that exemption amount to $500,000.
Right.
So if we use the same example where you have $1 million capital gain and you're selling a primary residence, the way it would work is if you're married, you would be able to exclude $500,000 from taxes, and then you would be taxed on the additional $500,000 that remained.
Right.
So it's important to note that there is not a 1031 exchange option for the sale of a primary residence. So that tactic.
It's only for investments.
It's only for investment properties. Typically commercial real estate, that type of thing.
Right. Now, so let's go a little bit more in depth into what the 1031 is then in terms of the exchange of property and the time frames that you need to hit in order for it to work.
Be happy to. So obviously, Section 1031, Section 1031 becomes very important because if you're considering selling your investment property, it's either reached its goal or you think the value is it's an appropriate time to sell. One of the considerations that you're going to have to go through is the impact of taxes. So once you get the sticker shock about the amount of taxes and what you're facing, you're going to look for alternatives.
Right.
The most common recommendation that a tax accountant or a CPA or someone like that is going to give to you is to consider doing a Section 1031 exchange. And really what that is, the concept behind it is if you take property A, and let's just give it a value of $1 million, you can replace it. You can sell property A, and then you can take all of the proceeds from that transaction. So in this case, $1 million, and you can exchange it into property B as long as property B is of equal or greater value. So an example would be you bought something for $500,000, it's grown to $1 million of value, and you decide to sell. You would have to replace it with another property that had at least $1 million worth of value. To the degree that you had any financing in place and any debt, you also have to replace the debt in an equal or greater fashion as well. And that part trips up a lot of people because they just want to take the profits
right.
and reinvest that in the new property. And unfortunately, that's not allowed. So to review quickly, you take property A and replace it with property B as long as it's equal or greater value. That's the first step. The second step is there's a time requirement in which you have to do this. So the government gives you 45 days from the close of escrow on property A to identify a potential replacement.
Right. So I sell my house, I put it up for sale, or it's an investment property. I put it up for sale with a guy, and he knocks it out of the park. He gets it, in escrow after 20 days or whatever, and then it's a fast cash escrow. Let's say it's only 14 days of escrow. So clock starts ticking when escrow closes, correct? Not during the escrow.
That's correct. So what would happen is, let's say you accept an offer on the 1st of the month and you close on the 15th of the month. From the 15th going forward, you would have 45 days to identify a potential replacement. Now, there's a couple of rules there, and I won't get into the weeds there, but the most commonly used one is the rule of 3. So typically you're going to identify 3 potential replacements that you're confident that you're going to be able to close on at least one of those. So on the 45th day, you're going to be using a third party. This third party is called an accommodator, and you're going to identify 1234 Main Street as a potential replacement for 1234 South Street. And so you've satisfied the first requirement, which is you've identified this potential property prior to the 45 days. Now, the second part of it is you have a total of 180 days to close that transaction.
So it's just about sorry to interrupt, but it's just about finding that property and getting into escrow. So you have 180 days to close it.
Right. You have 45 days to identify it, and you have a total of 180 days to, perform due diligence and go through the inspections and financing and things like that. If you identify a property and for some reason it doesn't close during that 180 days, something happens, I know, Tom, you don't have escrows fall out, but
Never.
Some other folks I've worked with in the past, sometimes escrows don't close.
Yeah.
And if that should happen when you're in a 1031 exchange, you've already missed the 45 days to replace it with another property, and you didn't close in the 180 days. Therefore, you would have what's called a failed exchange, and then the capital gain tax would now apply.
So all of a sudden, the seller is going to be very unhappy with you, right? The agent, because basically you didn't find that other property or it didn't work out, right? I mean,
absolutely. And there's no greater hornet's nest to be stirred than to let someone know who intended to do a 1031 exchange know that they're not going to be able to satisfy it.
Right.
So some common terms you hear at this time that get confusing and people may not, they've heard them but may not realize what they are. A 1031 is often referred to when you sell the property. That's what they call the down leg, and when you replace it, that's called the up leg. I don't know why that started, but those are common terms that are out there. So when you're talking to a potential agent or realtor who says, "Oh, don't worry, we'll do a 1031 exchange, and I've got many replacement properties, or I have the up leg available for you," that type of thing, that's what they're talking about.
Right.
So one of the risk factors in doing a 1031 exchange is when we take a market environment like we face today.
Well, I was about to say, is that inventory is so low nowadays that it's sometimes very difficult to find alternates.
It very much is. So I have some live examples where on the west side of Los Angeles, for example, it's a very competitive market, multiple offers, often over and above the asking price and things like that. So you have to remember that you're competing. So yes, your property might be fetching a significant value, and you're going to recognize a great profit, but you have to recognize that you're competing with other buyers for a replacement asset, right, which is good because competition is what is driving the real estate
Prices
market.
Up.
Absolutely, but you're also buying it. So I like to make a little joke. I said, look, right now the price of doors and dirt is very, very elevated. And, you might have purchased your investment property at a time when the rate of return, a lot of people use the term, the cap rate, or the rate of return that you were getting might have been in the 7 to 10% range, which is often a very attractive market for investors to make a purchase or to invest in real estate. Well, it kind of works like a seesaw. So when the value of existing real estate goes up, that inherently drives down the cap rate because the cash flow remains constant.
Right.
So if you bought something at 10% and it was $1 million, and now the value has gone up to $1.5 million, maybe your cash flow is only now yielding a 5% rate of return on a larger number, but it's the same cash flow.
Right.
So if you sold that, you might not be able to replace it with another asset that's replacing the percent rate of return that you're looking at, the cap rate. So everybody wants to sell their property at a 3 cap, and they want to replace it with a 10 cap.
10 cap, yeah.
So that's where a program like ours has been very instrumental in helping those investors that use it take advantage of the elevated pricing and move their assets out into an alternative structure.
So with 1031s, to kind of stay here for just a moment longer, to just kind of to get an idea, one of the things that I found the kind of the most confusing aspect of this thing when I was first kind of getting to know them was in what kind of scenarios would people want to do this? Like, why are you just moving things around? It sounds to me like you just have another investment property that's now worth the same that you know what I mean?
And that's a good question, Tom. So the 1031 exchange has been a valuable tool when you're able to maybe skip a market cycle. So let's give an example. I think that a lot of people would agree that the real estate market has peaks and valleys.
Right.
So maybe you were fortunate enough to acquire a property maybe 2 cycles ago.
Yeah.
So maybe you bought something, let's say 20 years ago, and you bought it for $250,000 instead of $500,000,
Yeah.
and now it's worth $1 million. Well, what people will do is, you want to always buy low and sell high, which is very difficult. And the premise of a 1031 exchange is that's a vehicle to take advantage of that. But to do it efficiently and really capitalize on it properly, the longer you've held the property that you're relinquishing, the better off you're going to be in trying to replace it for value. So to say it a little bit better, you really have to do the math, because you're right. So what it forces people to do often in a very tight market like we're in today is they're looking towards taking on maybe unnecessary risk or unfamiliar risk to them. So an alternative might be you can sell your apartment building in Santa Monica and get it, maybe you sell it for a 3 cap, and then an agent, typically from a large national firm, will say, hey, I've got affiliates in other markets. How do you feel? We have a 10 cap property available for you.
So it's more about switching to a place where that kind of the cap rate you can gain there, or you can do something that somehow gives you an advantage.
Exactly. So you might want to.
It's not just about this was cost this one and this one cost that. You're looking at the actual, the net sheet, and you're looking at it going, oh, I can probably get another like that.
Exactly. So you're forced to take on different risks. So one of them is location risk.
Yeah.
So, I'd have a hard time convincing someone to sell a property in Santa Monica, for example, and reinvesting maybe in Greeley, Colorado, or Austin, Texas.
What do you got against Greeley?
But, a lot of people do it. So, they look for value-added opportunities across the country. That's a certain type of investor.
Right.
Real estate tends to be a local business, and people are attracted to owning investment real estate because they can touch it, they can see it, they can drive by. Right. And many of our listeners, they enjoy the repair work. They like working the property. They like knowing the tenants, and they like the aspect of running that business. They may not be inclined. Other opportunities that come up are what, I'm air quoting right now, but what they look for are what they call value adds. So maybe you would buy, you sell a property in Santa Monica, and maybe you go to an area like Stockton, California, that's undergoing some
renaissance of sorts.
Yeah, it's going through a renaissance, and you might be able to get something there. And if you're the kind of person that can throw a coat of paint up and maybe do a unit with the carpets and their appliances and things like that, and you add value to the opportunity, that's good. That tends to be a younger investor's game. Right. As investors age, they're less inclined to do that.
To do those kind of risky, quote unquote, risky things.
Exactly. So, there's no free lunch. There's, especially today with the type of data that's available to agents and investors, there's hidden gems out there, but they're much more hidden than they used to be.
Yeah.
It's much more difficult to find those hidden opportunities.
Right. So now what's interesting and what you kind of specialize in, though, is not 1031 exchanges. It's an alternate to 1031s. Why don't you explain a little bit more about that, like in terms of maybe, and why would anybody want to do, if this is some sort of interesting thing of where you can, switch things up in order to get maybe a higher profit or something like that. Okay, great. But why would I want to do something else? So let's start with what your alternate scenario is.
Sure, Tom. The program that we market is something called the Deferred Sales Trust. Now, remember, before you start going on the internet and looking at the IRS, the IRS.
There's no number attached to this one?
There's no number attached to this. This is just a proprietary name that we trademarked, and we refer to it as the Deferred Sales Trust. But in essence, what it is, Tom, it's a vehicle that allows someone who owns real estate to sell that real estate, keep that transaction tax deferred, very similar to what a 1031 exchange does. Because remember, when you sell your property from property A to property B, you do that on a tax deferred basis. And I'm going to stress that word deferred often. Okay. Right. So the Deferred Sales Trust allows you to sell the asset, keep that transaction tax deferred, and then at the close of the transaction, you have access to those funds to be deployed or invested into other things that may not include real estate. For example, you could sell a 4-unit apartment building And at the close of that transaction, you can take the proceeds from that and maybe invest in your business, or maybe you have a child that you want to help them get started in a business or something like that. Or you can invest it in with professional money managers and get a rate of return and turn it into income to replace the rents that you're losing. The point of it is there is no requirement that you replace that property that you're relinquishing with a new property. So in a 1031 exchange, you sell property A, you must acquire property B. In the Deferred Sales Trust, you sell the property. The transaction is tax deferred. However, there is no requirement that you replace it with any real estate whatsoever.
So what's the mechanics behind that? What's basically how that works?
Okay, Tom. Well, what I'd like the audience to do here, and we'll pause for just a second here why they shuffle their papers. If you could do me a favor, because it's very hard over the radio here to get a visual. But if you grab a piece of paper and a pencil and draw a triangle. So, but you want to make that triangle big enough to put some notes around. It makes it a little bit easier to follow sort of the mechanics. So I hear a lot of paper shuffling in the background there, and it looks like they're all
All right,
ready.
settle, folks. Settle. All right.
So what you want to do is you want to look at your triangle, and then in the lower left-hand corner of the triangle, you're going to see a spot, and I want you to write the word seller. On the lower right-hand side of your triangle, I would like you to write the word buyer. And then at the top of the triangle, I would like you to write the word trust. Now, in any real estate transaction, as you know, Tom, there's a buyer and there's a seller. And the first thing they must do is they need to agree to terms and conditions. And terms and conditions is really the price and the terms of escrow. So in other words, I'm going to buy your building for $2 million and we're going to close in 30 days. So that would be an example of terms and conditions. So a way to remember it is to draw a two-way arrow between the seller and the buyer.
Basically, it's a transaction where people are talking to each other.
They're talking to each other and they shake hands.
Shake hands.
All right. So as you know, when you shake hands in real estate, generally a contract follows, and the process that follows is called escrow.
Right.
So step number one, a two-way arrow at the bottom of the triangle that points towards the seller and the buyer. Step number two, we're now entering escrow. So during escrow, what's going to happen is that this property is going to be transferred into a vehicle called a business purpose trust.
Can you define that? What is that?
There's many types of trust, and a common question I get at this point, Tom, is, well, I already have it in a living trust or a family trust.
Well, my wife is a wills and trust attorney, so basically we understand the concept, and we talked about it when she was on the podcast, and it's basically about putting your house in a trust so that basically when you pass on, the trust is not, it's kind of independent, and it moves to whoever the beneficiary is.
Correct, and I'm sure as your wife mentioned, a living trust or a family trust, which is what most of the listeners are probably familiar with, is really a vehicle of transfer. It does not have any inherent tax benefits to it. There's a common misunderstanding that by having a living trust, there's some tax benefits to it, and that's not true. The main benefit of having a living trust is that you avoid the probate process.
Right, the fees that are associated with that too.
Correct, but there is no inherent built-in tax savings. A business purpose trust, however, is a trust that's created to be a legal entity and to execute the function for which it's been designed. In this case, it's to own and operate an asset for a profit.
Right,
Therefore,
which would be the property.
Which would be the property and or the assets or whatever remains.
Right.
It could be anything that's in there, right?
Right.
So in this point, we would create a business purpose trust on behalf of the seller and create a tax ID number for the business purpose trust. And then at some point, the seller is going to actually physically transfer the property into that trust. And as I mentioned earlier, it doesn't matter the current form of title, because when you really think through the transaction, it's getting removed from whatever vehicle it's held in now, and it's going to be transferred to the new buyer anyway. We're just taking an interim step here and transferring the property from the seller into the business purpose trust. Okay. Now, escrow will commence, and there's going to be contingencies that need to be satisfied and things of that nature. And the ones that we look for to be satisfied, so we have a good indication that this deal is actually going to close, is when the inspection, the financing, and the appraisal have been satisfied, and the seller has signed off on those and the buyer has signed off on those. We know we're going to close.
Right.
So at that point, the trust will then complete the sale with the buyer.
Okay.
So step number 3, you want to draw a downward arrow from the trust to the buyer. During that process, the property is now inside of the trust, so it's important to have that takeaway that technically right now the trust owns that property.
Right.
And will actually convey that to the buyer. So if you take your pencil and you draw a $ inside of the triangle, that would really represent the buyer's consideration, or otherwise known as their cash.
Right.
So they're going to make a purchase and they're going to use either a combination of cash and debt, or in today's market, many people are doing their transactions with all cash. At any rate, the money gets deposited into escrow. Escrow is going to do what they like to do, which is net out the transaction.
Right.
They're going to pay off any mortgages. They're going to pay any fees or commissions or taxes or all the different things that go through the escrow process. Now, at the conclusion of escrow, the buyer gets the property, and then the escrow officer is sitting there with a check, and they have to make a determination of where that check goes.
Right.
Now, in a residential transaction, often the check goes directly to the seller, and they take it to the bank, they deposit it, and they wait for their silent partner, otherwise known as the taxing authorities,
right,
to come and get their share. In this transaction, however, instead of sending the money directly to the seller, the money actually goes to their previously established business purpose trust.
The trust. So the trust gets the check.
And that's a very critical element of this transaction.
Okay.
The reason for that is that there's 2 parts to capital gains. So when the seller sells it, they've incurred the tax liability of the capital gain, but they have not recognized it. So it's getting a little technical here, but the gist of it is you can incur the tax liability, but the IRS doesn't feel that you've recognized it until you've actually touched the cash.
Well, you're not taking advantage of it. You're not putting it in your bank and, then it becomes income or whatever it is, right?
Yeah, the catchphrase is what they refer to as constructive receipt.
Right.
So if you haven't had constructive receipt, technically you haven't recognized that gain. Getting a little bit in the weeds, and again, make sure you check with your local tax accountant and tax attorneys and such to verify this information. So,
right.
But the point of it is that the money goes to the business purpose trust and is now held by the trustees of the business purpose trust. That makes the money tax deferred. And I'm going to use the word tax deferred. Now, Tom, no matter how often I say that word tax deferred and I meet with somebody and we go through this process, for some reason, tax deferred always translates into tax avoidance.
Yeah, no taxes. Yay.
So
it's like putting it in the, an offshore account in Bermuda or something.
Exactly.
Right? No.
So they get, for some reason it doesn't translate the way I say it.
They only want to hear what they want to hear.
Exactly.
Yeah.
So
right.
we stress that it's tax deferred and tax deferred only. I've shared with my son, who's a recent new attorney, and I said, well, let me explain the difference to you. Tax deferral, we all go to dinner. Tax avoidance, we all go to jail.
Right, exactly. It's a little subtle difference.
Exactly.
Right.
So I stress the word tax deferred.
Right.
Now, Tom, that being said, the money is now inside of this trust, and the trustees of the trust now have access to it, and they will typically deploy that. Remember, I mentioned that the vehicle that we're utilizing is something called a business purpose trust.
Right.
So, again, to kind of whittle it down into common English here, the purpose of this trust is to own and operate the assets of the trust for a profit.
Right.
That's air quotes here, the business purpose of that
so
trust.
Just to kind of, not to jump ahead here, but I would assume that means that then you can take the funds that are inside that business trust and invest them in a different way and all that, and then you're getting some sort of income off of that, correct?
More or less, yeah. So we'll talk a little bit more in detail about that.
Yeah.
There are some nuances.
I'm getting ahead of myself.
You are excited.
I'm excited. I love
it.
This is good.
But just to review the process here so everyone's clear. In a 1031 exchange, you sell property A, you take your 45-day window, and you find a replacement property, you identify that replacement, and you have 180 days to close it. And as long as you do that and the replacement property is of equal or greater value, that transaction results in tax deferral of your gain. In the deferred sales trust transaction, you're transferring the property into a business purpose trust, and the business purpose trust is executing the transaction with the buyer. The proceeds now belong and go to the business purpose trust.
I'm sorry to interrupt really quickly. Before with the 1031, you had said that it was only for investment properties. Does that same kind of thing apply here on these as well, or can it be personal residence?
Actually, Tom, it's one of the advantages of the deferred sales trust. It actually is for an asset. So the asset could be something like a primary residence.
Oh,
it could be an apartment building. It could actually be
so there is no distinction in this.
No, it could be a business. It could be an airplane. It could be
interesting.
It could be art. It could be a classic car.
Oh, wow.
Yeah. So it's really anything that results in a capital gain.
Where there's some sort of over the past years, you've made some sort of appreciation on it.
Yeah. Typically, the one thing that it doesn't do is in the case of selling common stock and things like that, that would not be something that would be eligible.
Got it. Okay. Right.
Generally, almost any physical asset could be. There's some nuances there, but for our purposes here today, it's pretty broad. But to review where we were, the end result of the deferred sales trust transaction really benefits with tax deferral. Now, I want to digress for just a moment because I know there's some people out there that are going to do some research here and they're going to look this up and they're going to want to know, okay, Tom, what's this guy talking about? And I want to go back to step number 1 because this is really the critical element of it. When the seller transfers that property to the trust, it's actually transferred through a section of the tax code referred to as Section 453.
Okay.
Under Section 453 of the tax code, which I had mentioned earlier actually predates Section 1031 exchanges, you are executing something called an installment sale. A lot of people use the term owner financing and things like that, but a broader definition is really an installment sale. So examples of installment sales could be something where you go to your local car dealer and you put a few $1,000s down and you buy the car and you drive off the lot and you make payments over time. That is an installment sale. You go to a furniture store and you buy a couch and you give them a deposit and you make payments over time. That's an installment sale. Many real estate transactions are an installment sale. You buy property and you put a down payment on and you make payments over
30
time.
30 years, 15 years.
You're making regularly scheduled installment payments.
One would hope.
Exactly. So we use Section 453 of the tax code to execute an installment sale between the seller of the property and the trust, which is the buyer of that property. So the example I like to use is one where the seller sells the property to the trust for $2 million. In exchange, the seller receives an installment note for $2 million. So now the trust owes that seller $2 million, and they typically will agree to a term. We're going to pay you $2 million in 10 years, and along the way, we're going to pay you 5% interest. That would be an example of an installment sale.
Got it.
So a balloon payment at the end, right?
Okay.
So the end result of that, now the trust owns the property, right?
Right.
The seller sold it to the trust. The trust bought it from the seller using an installment sale. This is the transaction that's done every day and has been done for hundreds of years. The trust now owns the property. Their basis in the property is now $2 million because that's what they paid for. They turn around and they actually sell it to the buyer for the same $2 million. So there's no gain to the trust at this point.
Okay.
So the buyer pays the $2 million. That $2 million goes through escrow and now ends up in the business purpose
So that's
trust.
how you get that deferral, is that it's the $2 million equals $2 million.
Exactly.
Oh, interesting. Okay, go ahead.
Okay. So now the trust owns the property and has the asset inside. So many of your listeners, Tom, might be scratching their head at the moment and say, Richard, let me get this straight. I transfer my property to the trust, and then the trust sells it to the buyer, and then the money goes to the trust, and all I have is a piece of paper.
Right.
And Tom, that is correct.
Yeah. Yes.
Okay.
As a matter of fact, yes.
So we want to make sure that they recognize is that they are executing what we would refer to as owner financing. Okay. So a more common use of owner financing in real estate would be Tom and I agree to a deal. I'm going to give him $500,000 down on this property because that's what I paid for it, and it's worth $2 million. Tom, I'm going to pay you $150,000 a year for the next 10 years, and I'm going to pay you 5% interest on that balance. So that would be an example of owner financing. I get a little money down, make payments over time.
Right.
From a tax perspective, the way that would be treated, if your original purchase price of the property was $500,000 and you sold it for $2 million, you roughly have $1.5 million gain.
Right.
Right. So you would be subject to capital gains, and we discussed some of the rates, what that would be.
Yeah.
Right.
Right.
So your basis is always tax free, and your gain is always going to be taxed at capital gain. And we talked about depreciation and the impact of that as well. But just to keep it simple, if I paid you $150,000 a year over the next 10 years, each year when you received your $150,000 payment plus your 5% interest, generally the way the tax impact would be as follows. You'd be subject to capital gain from the federal government. You'd be subject to gain by the state of California, and possibly, depending upon the amount of the transaction, you may also be subject to the Medicare capital gain as well.
Right.
And then we mentioned depreciation where that applies. So we view this as having two risks. All right. In owner financing, Tom, what do you think one of the main risks are?
Foreclosure.
Foreclosure, right. What we refer to as the foreclosure risk, the downside in the transaction with owner financing really rests and belongs to the seller. So the seller is really taking the risk in owner financing. Now, you might be scratching your head at the moment here and say, wait a minute, I sold it. I'm going to get $2 million.
Yeah, right.
Well, not everybody makes it through.
All the way through.
All the way through that cycle.
Right.
Now, if you're a younger investor, selling a property and then taking it back through the foreclosure property and things like that, that's certainly an appropriate risk. And in many cases, it's actually a strategy that many young investors use to grow their portfolio. Well, when you're older and you're selling your portfolio, you may not be as anxious to take a property back. Because Tom, as you and I both know, as old gray beards here in the business, most people do not default on their real estate in up markets.
No, it's usually the other way around.
Exactly.
Very much so.
So what we like to say is, look, all the upside in the transaction for owner financing really belongs with the buyer. All the downside risk really belongs to the seller.
Right.
The best that could happen to the seller is that the buyer satisfies the terms and conditions of their agreement.
Right.
Well, we think there's a hidden risk over and above that of foreclosure, or default is more accurate, right?
And that is?
We think there's reinvestment risk.
Okay.
Because when you close that transaction, the value of the property to the buyer is $2 million.
Right.
The value of the property is what to you?
I don't know.
It's really the cash that you got. You got $500,000 in your pocket,
right?
And you're getting your payments over time.
Over time, right?
But you don't have $2 million.
No, you don't have the $2 million.
Right. So you can't go out and reinvest.
Oh, so you're losing that money that you basically is not in your pocket.
You're losing the access to that money to deploy in another way.
Right. Totally.
So we think you have what we refer to as reinvestment risk.
Right.
So as you get that money, you're taxed. And as you get it, you're getting it in bits and pieces.
Right.
You may not be able to deploy it in the same fashion.
So in theory, if you have $2 million in your pocket, that's going to be a lot more powerful than having $500,000, and you want to be making money on $200 million, not on 500 plus 150 each year.
Exactly.
Got it.
Okay.
It makes total sense.
Right. So the Deferred Sales Trust results in a position where the seller of the property now has $2 million working for them up front.
Right.
And they have the money, they're done, the buyer has the property, and the seller has the cash, or the cash is actually technically belongs to the trust and is inside of this trust.
Right.
Okay.
So basically that money's cooking up there. You can put that money where to work, basically.
And that's one of the benefits of having the money inside of the Deferred Sales Trust, is that the trustees of the trust, they now own the asset. Now that asset could be cash, it could be investments, it could be other vehicles, but typically it's going to be cash in the beginning. The trustees of the trust are now able to invest that money in such a way that it generates a rate of return to satisfy the installment contract that I mentioned previously.
Yeah.
And the trustees are hopeful that they're going to grow that, and they can participate in the upside of the growth of the trust.
Got it.
So that's the benefit to the trustee, is that the trustee is able to enjoy the upside of that transaction.
So is it that so let's say you've got, $2 million that's, earning 10% or whatever, just to make the math easy. And so is that 10% coming down to the seller at that point, or is it staying in the trust?
Yeah, I've got a better example memorized, so I'll use that.
Oh, go for it.
So it's a fair question. So let's assume we have $2 million in the trust, and today's market, people I think would be happy with a 5% rate of return.
Sure.
So based on a 5% rate of return, that would be $100,000 a year.
Right.
That gets that gets distributed to the seller, right? So that $100,000 a year comes out, and that's going to be taxed on behalf of the seller at ordinary income rates.
Okay, which is significantly lower.
Potentially, depending upon their overall financial
whatever
situation. Right?
Yeah,
so
they have a good accountant.
Well, and they could take advantage of the new
Right.
tax rules that everybody's trying to get
Right.
their arms around. But that being said, so they now have $100,000 a year of income coming in. It's going to be taxed as ordinary income, just like any other investment to them would be. And
silly question, but because there's such a significant now difference between corporate taxes and individual taxes, can corporations do these trusts or no?
That's probably something a tax attorney is going to be able to ascertain, and with the new rules being in place. And
because I was just wondering I would assume a lesser impact if you're a company, if you can.
Yeah, most of the transactions that I'm familiar with have been really through and by individuals.
Yeah, got it.
Now that being said, you could sell your business and things like that.
Yeah, right.
But ultimately, it's the owner, the individual owner, that benefits from this kind of transaction. Corporations got a lot under this new
they did
new tax passage here. Tax law. Anyway, but I want to get back to the income. So the income, the interest or the income being paid to the seller is going to be taxed as ordinary income. That $2 million that's behind, or what we refer to as the corpus of the trust, that's going to be tax deferred. So as long as that remains inside of the trust, it's in a tax deferred status.
Right.
So let's say some time goes by and the seller decides that they want to have access to some of the principal or the corpus of the trust. So they work with the trustees of the trust, and they orchestrate what we would refer to as a distribution.
Okay.
When they receive any distribution of principal, it's going to be taxed the following way. It's going to be subject to capital gain taxes. So everything happens on what we call a pro rata basis. So in the example,
go into detail with that. What does that mean?
So in the example I think we used, they bought the asset for $500,000 and they sold it for $2 million. So technically the basis would be $500,000. $500,000 of $2 million is 25%. So let's say they took out $100,000. 25% of that $100,000 or $25,000 would be tax free. The $75,000 would be taxed on a pro rata basis. Okay. Now, one of the advantages to taking it out in installments over time is that capital gains are taxed on a sliding scale. So instead of taking the lump sum like you would have in the beginning, and we talked about the impact of potentially as much as 37.1% in taxes, you might be subject to much lower rates because you're taking it out in smaller increments, and you may not reach the maximum levels of each one of those.
Oh, so it's like a sliding scale. The 37 is the max, right?
Currently that would be the maximum.
Right, but if you're bringing it out in chunks, you're not getting that big hit, such a big bite each time.
Right. Like we reviewed
Got
in the
it. That makes sense.
Exactly. So we reviewed in the beginning that, they started.
Okay. That makes total sense. All right.
Yeah. So they start at 15%, go to 20. They
Yeah.
start at 9.3 and go to 13.3. So,
Right.
Often I struggle with the conversation. I'll tell someone, look, instead of paying 37% in taxes, maybe we might get it down to 25. They go, oh, you saved me 10% or 12%. No. What we've actually done is we saved you like 30% of what your tax liability is.
Right.
So we try to we try to clarify it as much. Yeah. That's where what do they say about statistics? You can make them sing or dance.
Yeah, right.
Depending on what you need them to do.
Yeah.
Exactly. So, but in real dollars and cents, it's been my observation that people generally are going to pay a lower overall tax when they pull the money out over time.
Got it. And I would think that there's another advantage to going this way because, in terms of for a couple of things. Number one, because like we kind of chatted about how there's so little inventory out there right now. So doing a 1031, you might there's a much higher chance you're not going to be able to do a swap of property to property. It's just a little bit more difficult, or a lot more difficult actually, with the market the way that it is. Number one. Number two, this is a great advantage because what if I don't want property? What if I want to sell my investment and I don't want to be a property manager anymore? I want cash. I want money. It helps in that way too, correct?
Tom, I think I just heard a bunch of screeching brakes and people, stopping in their tracks. This is an audience full of real estate investors, and to even indicate for a minute that no one wants to own real estate going
how
forward.
Could you, Tom?
Blasphemy.
What?
But you're
buy
right.
Buy and hold, folks. Buy and hold. I say that.
But you're right. Sometimes circumstances dictate that people consider, either diversification, for example. Maybe they have more real estate than they probably should relative to their risk or their age or their physical capabilities and things like that. To be frank, a lot of the people that I talk to who express interest in this, they fall in a category often where they may not be the professional long-term real estate investor. They purchase real estate as a tool. Their idea was to purchase it for retirement.
Yeah.
And lo and behold, here's retirement, and they're kind of thinking about where they're at.
Sometimes grandpa is tired of climbing up ladders and fixing light bulbs and doing stuff. It's time to just kind of go and play some golf.
Absolutely. And unfortunately, in today's world, another thing that's happening is people are holding their assets longer. They're working longer.
Right.
And I see a lot of situations where, a couple, husband and wife, owned and operated the property for a while. Often it was the husband maybe who was doing more of the physical manual labor at the property and things like that. And, unfortunately, they may have suffered a health issue, or they're in decline. And, the wife or the children don't really know the property as well. They don't really want it. They don't want to be collecting rents in the middle of the night and dealing with heaters,
plumbing overflowing. Yeah.
Exactly.
Yeah.
So it's an opportunity. Or in many cases, with the significant appreciation that we've seen in the real estate market, a lot of times the value of the asset has really outpaced any and all of their expectations, and maybe the property needs repairs. Maybe it's a value add opportunity for someone else, but maybe this family or the current owners just don't have the capacity to execute a value add situation. They don't have the cash or the credit, or they don't want to deal with it. Or, as blasphemous as it sounds, they're just tired of owning real estate and they want something else. Right. And they want to enjoy the beach and do other things. So it's a great exit strategy. I'm fond of saying when the moving parts line up, this is an alternative that can be considered. Surprisingly, another area that we're beginning to see more and more of our clients and their advisors use us for as really a 1031 exchange backup.
And that makes sense to me. I mean, just in case. I mean, and how, what part of the stage can you start prepping this as a just in case?
Well, there needs to be the risk that the transaction cannot go forward. So the term that the lawyers like us to use is called contingencies. So as long as there's still outstanding contingencies that are significant, that can result in the risk of the transaction
Falling
not
apart,
closing,
yeah.
then we can do our work.
Got it.
So the attorneys make that assessment, and the tax attorneys are very good at providing information, and they'll give you an initial assessment, say, well, you're too far, you've missed some of these deadlines, or you're too far past what the IRS is comfortable with and allowing. So let's just assume that the contingencies and things like that are necessary. You can bring us in anytime. Typically, you can bring us up anytime prior to the close of escrow is generally going to be acceptable. If you're in the up leg, down leg process, you're in what we call the identification period, that 45-day window. It's a little bit more difficult sometimes to execute it. It's not impossible. It's just more difficult. And there are instances that even if you get in that 180-day period and the deal just falls apart and you're just stuck, there's been some situations where we've been able to
resuscitate it, or not resuscitate it, but
at least save it. Yeah, and again, I'm always fond of saying, I'll tell a quick story. My son is an attorney, and he came home all excited about law school in the very beginning, and he said, "Dad, I learned everything I need to know about law school." And I'm like, "Great!"
I save all the money.
Yeah, well,
no more tuition.
Exactly. Help help understand exactly what happened, right?
Right.
But what he said is that the professor was up there and said, "I'm going to teach you everything you need to know about law school today." And they're like, "Okay, great." So all these kids are, what does he say? He says, "It's this simple. No matter what question you get asked, the answer is always, it depends." And they're kind of looking around at each other like, that's it? Those are the words of wisdom? There's Moses speaking?
Right.
And he explained, he said, because two reasons. You're never wrong, and it always leads to billable hours.
There you go. Another conversation. Another
exactly.
email that takes
made a
time.
lot more sense.
And billable hours.
And then I think they all felt much better about their tuition requirements after that.
There you go.
So.
All right. Well, any final takeaway that you want to make sure that everybody kind of knows or understands before we wrap up? Yeah,
Tom, it's been a pleasure to talk to you about this, and hopefully make some of your listeners interested in learning a little bit more. Again, the intent of the conversation here today, as you know, is just to kind of get this out there and let folks know that there are some alternatives to a 1031 exchange. Obviously, we want you to take the care and the guidance and wisdom of your own tax people and have them contact us and learn more about it. But like I said, this is a tax code that exists. It's section 453 of the tax code. The legal part of it, the trust part of it, is called a business purpose trust. And it's the combination of those two things that really make this work. I use my name as a joke when I give an example. With the name Hershey, you can imagine all the questions I've been asked over time, right? And obviously there's no relationship.
Yeah.
But 100 years ago, there were two salesmen on an elevator going up to see the Candy Wizard, and one of them was selling chocolate and the other one was selling peanut butter. And during the trip up to the sales floor, the elevator hiccuped and they bumped into each other. And, the end result was the peanut butter and chocolate mixed and created something called the Reese's Cup.
Right.
So the Deferred Sales Trust is very similar in that it's really a combination of two different techniques. One is utilizing the technique of an installment sale, and the other one is utilizing the technique of a business purpose trust. But Tom, it's important that it's the sequence of how each one of these are used that yields the end result. Either one of these by themselves would not be able to deliver the benefit, again, of tax deferral that we talked about earlier. So again, thank you so much for the opportunity. I look forward to anybody responding to this.
Yeah, why don't we just go right here and tell us what your contact info is so we can get in touch with you.
Great. Well, I have a website, and the name of my company is the same. It's WeReduceTaxes.com, and I have a video that's on the homepage that explains.
And let me interrupt here. It's a very informative one, and I learned a lot from just the video that was there. So I really think everybody should check that out.
Thank you so much. So again, it's WeReduceTaxes.com. I encourage you to watch the video. We do provide additional information. I have a free report that's available, and there's an opportunity on the sign-up page on the website. If you'd like to get our free report, we're happy to send it to you. We're more than happy to work with your tax advisors, your financial advisor, your real estate consultants, and things like that. We are, we're a tool to complement your team. We're not in competition with anybody that you currently work with and trust. We're just an additional resource that maybe they're not familiar with.
Great. So just go to the website and all your information's there.
It is, and I appreciate the opportunity again to share.
Richard, thank you so much for coming.
You're very
Really
welcome.
appreciate it.
Thanks, Tom.
Well, that's about it for today. If you have any questions or comments, please don't hesitate to leave them for us on our Facebook page, facebook.com/Clarified Realty Podcast, all one word. If you have any questions about real estate or you're looking for someone to help you buy or sell a home, remember, I'm actually a licensed real estate agent. I'd love to help you out, so please email me directly at tom@clarifiedrealty.com or give me a call at 818-335-7662. Don't be shy, guys. Come on, give me a ring. For more exclusive bonus content and advice between episodes, please check out our website, www.clarifiedrealty.com. Also on our homepage, you'll find links to helpful buyer and seller guides that can give you guys some really great information for starting your home buying or home seller process, so definitely check those out. And here's something we're very proud of. We have a top-ranked Alexa skill. So search the Alexa store for the Clarified Realty Podcast, add our skill to your daily briefing, and get a dose of real estate news and tips every day of the year. That's right, every day. Definitely give it a try. I think it's pretty cool. I'm on Snapchat, Twitter, and Instagram as well. My handle for all three of those are @ClarifiedRealty. Please leave feedback and reviews on iTunes or in the comment section on our page. Together we're stronger. I say this every week, folks. Come on, together we're stronger. So if we have any questions or ways that we can make this podcast better, please let us know. My amazing theme song, Hey Now, is from the band Wolf. That's Wolf with 2 Fs. And please go check them out and like them on SoundCloud. And just a little fine print here. My brokerage is Keller Williams Encino Sherman Oaks. I'm licensed by the California Bureau of Real Estate, and my license number is 01715353. The advice we give is only for properties located in the state of California. For all other states, please contact your local real estate agent or real estate professional. Well, thanks for everything, guys. Thanks for coming by. And remember, the greatest thing you can ever do is make someone feel at home. Take care. We'll see you next week.